Good morning, this is Drew Erickson talking about money, not math, because I believe most people love money without realizing how often it doesn't work the same way as math. Today I'm highlighting another section from the book that I'm reading, Missed Fortune, Dispel the Money Myths Dispel the Money Misconceptions, Isn't It Time You Became Wealthy by Douglas Andrew. And today we are talking about tax bracket misconceptions, or more specifically, marginal tax bracket misconceptions. And I tried to draw, I'm going to read an excerpt from the book and then show you an example with today's updated tax laws. Now, keep in mind, I am not a CPA. I do not give tax advice from a filing standpoint. So if I messed up on any of my numbers here, I apologize. And if you're a CPA and you can correct me, feel free to do so. So here's where we go. So he says tax bracket misconceptions. Taxpayers often complete their tax returns, and the tax preparer may say, well, you're on the verge of moving into the next higher tax bracket. In other words, their taxable income is about to cross the threshold from one bracket to the next on a federal tax standpoint. This alarms the taxpayer because of the misconception that all income up to that threshold, as well as any over that threshold, will be taxed at the higher rate. Not so. You only pay the higher rate on dollars earned in excess of each tax threshold. Okay, so that's a lot of words, and I know it can be confusing, which is why I want to draw out an example for you. So prepared an example with a lot of information. Please just try to follow along, and I'll talk through the entire thing without trying to get too into the weeds, because I know I have a tendency to do that sometimes. Here we go. All right, so here's tax bracket misconceptions. Hopefully you can see my screen. So as you'll see, this is 2019 tax bracket rates for married couples filing jointly. How you file also always depends, but I just only want to use one example. In 2019, you can write off individual filings, or you can take a personal standard deduction of $12,200 if single, $24,400 if married, and $18,350 if you are the head of your household. So with that in mind, to differentiate what most people think, or not, I shouldn't say what most people think, what the misconception can be is if you're in a higher tax bracket, all of your income gets taxed at that highest bracket. Okay, so I'm going to use the misconception first. So if you are making $193,400 with your spouse and you take your $24,400 deduction, your taxable income is about $169,000, which would put you in today's rate at a highest rate of 24% marginal tax rate. Okay, so that would be your highest rate. So what the misconception is that because you're at that highest rate, you're going to pay 24% on your entire income. Well, 24% of $169,000 of income would be $40,560 of taxes that would be owed. That's where the misconception comes in, and when given the advice of, well, we need to lower your marginal tax rate, so you better put away, in this case, $700 or $601 to get below $168,400 to lower your tax bracket, so that your highest tax bracket is 22. Thinking that now all of your money would be taxed at 22% rather than 24. However, that's not how it works. Okay, so we aren't taxed at our entire income with the highest rate. In this case, the only amount of money that this person is taxed at 24% is the $600 that he makes over the $168,400 threshold. Okay, so he is not, the misconception that we are taxed our entire income at our highest marginal rate is incorrect. What actually happens is we're taxed at our marginal rate for each income bracket. So for the first $19,399 this person makes, he's going to pay a 10% tax rate, which is $1,939.90 of taxes. For the income between $19,400 and $78,949, he's going to pay 12%, or he or she, I should say. They're a married couple here. They're going to pay 12%. For their income between $78,950 to $168,399, they're going to pay 22%, all right, which is about $19,678.78. Now, like I said, for the remaining $600, right? Because they make $169,000 of taxable income. They're going to pay the highest marginal rate of 24%, which is only $144. So when we add all this up, the actual taxes that are owed for this person are $28,908.56, not $40,560. Okay, so this is just one of many tax bracket or tax misconceptions that's very important for us to understand when it comes to planning around our money. And the reason why it's important, like he says in his example that I'll cover tomorrow, and like I briefly alluded to, is when deciding where you're going to save your money, if you're looking at putting $600 or $700 in a tax deferred IRA, like a traditional IRA or 401k, to lower your tax bracket, all you're doing is decreasing the amount of taxes you're paying on the last $600 of your income. You're not decreasing the amount of taxes you're paying on all the income before that. Okay, and that can make a very important difference when it comes to planning around your money and how you will be able to use that money in the future. Okay, so I know this one was very in depth when it comes to details, and hopefully it was clear. I know I'm never as clear as I hope to be, but hopefully clear enough to bring you value. Please let me know if you have feedback or questions or corrections, because I know I don't know everything and I make mistakes on this video. If you liked it, please click the like button, or even better yet, share it with a friend. Thanks for taking the time to watch, and have a great day. Thanks. Bye.